Hello everyone and welcome to LRQA's webinar on emerging carbon reporting requirements. My name is Hassan Surwe. I am the Regional Marketing Manager for Asia Pacific at LRQA, and it's a pleasure to have you all with us today. Thank you, Katie. So before we dive into our session, I'd like to go over a few housekeeping items for you all. We will be sharing the recording of this webinar within a week of the session. If there are any questions, and please feel free to ask your questions anytime during the webinar in the chat, and we will have a dedicated question answer session after the presentations are over. We will also have a short survey which you can fill out after the webinar, and your feedback will definitely help us for our future sessions for you. Everyone who attends this webinar will receive a participation certificate from LRQA after the webinar is over. Thanks again, Katie. For anyone who is joining us for the first time, just a brief introduction about us. LRQA is a leading global assurance partner, bringing together decades of expertise in assessment, advisory, inspection, and cybersecurity services. Underpinned by data-driven insights, we help our clients navigate new era of risk. Yeah. Next slide. Thank you. And introduction about our speakers. We have two very, very distinguished speakers today with us. First is Katie Yewdall, who is our Director of Sustainability Consulting in APAC for LRQA. She oversees LRQA sustainability consulting within the APAC region, demonstrating extensive expertise in sustainability strategy, climate change services, and reporting across diverse industries. The other gentleman, as you can see on the screen, is Ayman Ktaily. He is a strategic sales manager for Middle East and Africa. He has 2 decades of experience in the tech industry, managing diverse teams across multiple countries with a proven record in business growth and team development. So without a further ado, we can dive into the session. Katie, over to you now.
Thanks, Hassan. Hi everyone, great to see you. Well, hopefully you can see me. Great to have you on the webinar today. So over the next hour, we're going to be talking through a few aspects of carbon regulation in the region. We're covering quite a big region today, but we will certainly still hopefully give you some practical insights and some practical advice on dealing with some of that regulation. So I'll start with an introduction, which Hassan's already done. We're going to talk a bit about the new regulation that are coming up for some of the regions. Sorry, some of the countries we're engaging with today. We're going to be talking specifically about quality data, do's and don'ts. So hopefully give you a few tips there on how to be producing the right kind of data for alignment with these regulations. And then we're going to be talking about potential support available. And at the end, we've got about 15 minutes of Q&A. So please do post your questions so that we can answer those when we get to the end of the session. So starting out with talking about regulation. So hot topic right now, a lot of people are talking about climate related disclosures, regulations, and these are certainly emerging globally. So what does this mean? Global disclosure is still pretty new, particularly in this part of the region. So there's lots of different reporting standards out there. There's lots of different requirements set by market regulators, etc. And certainly a lot of global stock exchanges, major stock exchanges, are making or intend to make climate-related disclosure mandatory for issuers across a few different locations. The majority of these exchanges, even though they have differing regulations or different details as part of that regulation, a lot of them require issuers to report against the International Financial Reporting Standards, or IFRS, or the TCFD, the Task Force for Climate-Related Financial Disclosures. So there are certainly some commonalities which I will talk about during the session today. It can still be something that's quite complex, particularly if you're starting out in this journey. And and kind of wading through the different regulations and the different types of requirements for various stock exchanges can be certainly a challenge. So hopefully there'll be some tips for you to get through those today. First, I wanted to talk about why these disclosure regulations are becoming so much more widespread. So there's a few things driving these types of requirements. The first one is certainly stakeholder demand. So customers, people that, employees even, but certainly also investors are looking for this kind of information, this kind of data. They're looking for companies to show goodwill by being transparent about their climate-related activities, and they're looking for accountability from companies in order to demonstrate that companies are doing what they can to manage climate-related activities that they are part of. So certainly a lot of stakeholder demand on companies to produce this kind of information. Customer and client demand. So you may have customers who are also reporting, or they might have regulatory reporting requirements and you don't, but they will be requesting potentially some information from you in order for them to be able to report. They also may have frameworks in place that make it easier for them to work with suppliers who are producing this kind of information. So certainly increasing demand from clients and customers is another driver for increasing carbon disclosure regulation. The other one is national agendas and mandatory requirements, which I've mentioned already. We'll dive into those a bit more in the next few slides. But certainly countries are becoming much more ambitious with their nationally disclosed contributions or national commitments. For example, since we're talking about the Middle East region through to Africa and all across Asia, there's a whole range of different national commitments that are being made. But for example, Dubai recently made a commitment to achieve 50% reduction in carbon emissions by 2030. So that's just one example in many national commitments that are being made across our region. And then finally, it's not all external or externalities that will be pushing companies to make disclosures, but actually there are operational efficiencies that can be gained from disclosing. If you're not monitoring it, if you don't know how much carbon you are responsible for, and you can't therefore manage it. So doing the reporting, doing the disclosure, if you have to do it for regulatory reasons or client reasons, make sure it's also useful for yourselves too. Make sure you're using that data to provide yourself with more information on how you can make improvements to your own activities, your own operations, so it is beneficial for all of those parties involved. So regulations are very different across the different regions. So this is kind of a regional view for now, and I'll dive into our region in a second. Europe is probably one of the most advanced when it comes to carbon disclosure requirements. There have been quite a few EU directives all over the rest of Europe that do set common standards or common requirements for the EU across member states and for individual countries across stock exchanges, for example. In the United States, there is certainly regulation for companies at the federal and at the state levels. And so there's emerging regulation that you need to be aware of, particularly due diligence regulation, which may be something that is important for you if you are working with American companies, for example. And then finally, Asia is pretty diverse. There's a whole range of different approaches to carbon-related disclosure in Asia and the Middle East. And this creates a lot of challenges, but it also means that the region is kind of moving together. I think, maybe a few changes within the countries, but as a whole, certainly moving together towards increased carbon disclosure and increased carbon management. I also want to pause here for a second and talk about the difference between due diligence regulation and disclosure regulation. So there is a difference here. Disclosure regulation is something that's been around for a very long time, and it's usually stock exchanges that are requesting issuers, for example, to disclose their carbon activities. There is usually, with disclosure regulation, very little requirement for companies to reduce their carbon. For example, they'll just be asked for transparency and accountability, as I mentioned earlier. They'll be asking companies to be transparent about their activities. Due diligence regulation is a little bit different. Due diligence is, it's not just reporting on what you're doing, but it's actually reporting on the actions that you're taking to be diligent about carbon activities, not only for yourself, but within your supply chains. So this supply chain element is why some of the regulations in places like Europe, the US, the UK are spreading through this region, because of course, supply chains are so global that we're feeling a lot of that regulation. It's becoming international as opposed to national. So there are certainly differences across the region, but there are similarities. So I wanted to highlight a couple of similarities on this slide. So I've just included EU in there to give you a comparison. But there is mandatory carbon regulation in Singapore, Hong Kong, Malaysia, China, Taiwan, and India. Well, sorry, India is sustainability disclosure, not specifically carbon. But these are just some of the first movers, and I certainly expect more stock exchanges to be focusing on carbon disclosure in the coming years. So as you can see, they all require Scope 1 and Scope 2 disclosure. We can talk about the differences in a few slides time, but they all require Scope 1 and Scope 2 disclosure, and some are also requiring Scope 3 disclosure. This is the tricky one, and we can talk about that in a bit. Some of them are optional, some of them are subject to materiality, some are coming in a phased approach. So Scope 1 and Scope 2 certainly, Scope 3 up and coming. Countries like India, the Philippines, Japan, there are various sustainability reporting requirements, so reporting disclosure, but they're not specific to carbon. And in the UAE, there's recently been some principles for sustainability reporting produced by the SFWG, which do ask for, they cover carbon within that. And certainly there's a move towards that in all the different, across the whole region. So although those differences do exist, there are some similarities. So we're covering, I can't remember how many countries we're covering in the session today, but it would be impossible for me to go through each one of those countries and each one of those regulation in detail. So what I've done is I've pulled together some of the key principles that carbon reporting usually encompass. So it's also worth noting that these are encompassed by the TCFDs and the IFRS, which are international guidelines for carbon reporting, for sustainability and carbon reporting. So hopefully this is, if you're hitting the 6 areas I'm going to talk about, so if you're hitting these 6 areas, you should also be hitting the regulatory requirements in your own country, although of course do double check that. So the first one is strategy and materiality. So it's important that companies are, this is the part that's really strategic and valuable for companies when it comes to carbon disclosure and any sustainability disclosure. This first element allows you to make sure that your disclosure is relevant to you, your activities, your stakeholders, and so it becomes a useful tool for you and not just a checkbox in terms of making sure your requirements are fulfilled. But strategy and materiality is usually part of the requirements, and it does ask that companies identify within their carbon activities which are the most material, which are the most strategic, where do they contribute the most to carbon emissions, where do they have the most control. So these activities right at the beginning of identifying the best strategy for your carbon reporting will help you to zoom in and focus in on where you can manage your carbon the most within your activities. The next one is governance. So boards of directors, when it comes to disclosure, are often having to assume direct oversight of pledges that are made, KPIs that are set. And so because of that, there is a need for governance structures within organizations to manage carbon activities, carbon disclosure. Usually they're part of an existing structure. It could be within your sustainability teams, if you have sustainability teams. It could be within your accounting teams. It could be within your CEO office, etc. But often there's already structures in place that subsume these types of responsibilities within their work. So looking at making sure that you have that you disclose your governance processes, the controls you have in place to check that data for accuracy, etc., which we'll cover again later, and the procedures used to monitor and manage risks and opportunities presented by climate change. So again, that's moving towards a bit of the strategy, making sure that you are using this activity as in a way that's useful to you as an organization, and not just to fulfill some requirements. Scenario analysis. This is climate scenario analysis. So quite a few of the regulations do require a disclosure on how a company is managing their climate change scenarios. So you may need some support with this from external organizations, but often companies are expected to conduct at least a qualitative scenario analysis. What this essentially means is, as the climate changes, what does that mean for you? What's the scenario for you as an organization, and what can you do to manage those changes? Transition planning is similar to scenario analysis. So once you've identified the changing and the different scenarios you might find yourself in, your organization, your company, your activities might find themselves in, what are you doing in order to plan for that? And how are you transitioning away from a carbon heavy type of activity towards something that's a bit lighter, so you can manage those, so you can reach for those targets that you're setting, mitigation strategies that you're setting, etc. Risk and opportunities is covered a little bit in the strategy, but certainly another area that a lot of regulations require disclosure in is looking at impacts of these climate risks and opportunities that they present to the company. It's not all negative, it's not all bad news. There's certainly some opportunities that can be found when you're looking at your carbon activities, your carbon contributions, and making sure that you are identifying those, analyzing that, gaining those insights can help to contribute to your business activities as well. Finally, metrics and targets. So the final part, you'll notice it's the last of the 6, is actually disclosing your emissions data. So I put scope 3 there, but actually a lot of the regulations ask for 1, 2, and 3. And so this is your carbon footprint, your carbon account. There's a few different terminologies for it, but your actual carbon emissions data, and also any progress that you're making towards internal targets set by yourselves, or any statutory regulations that are set externally. I'll also mention that assurance of this data is mandated by some stock exchanges, and that is also something that may be increasing as well. So making sure that data is accurate, of high quality, not only helps to feed back into making sure it's beneficial for you as an organization, but it is important because that data is being put out there into the world. So making sure that it's accurate and complete is also key, and one of the drivers for making assurance of data, third-party assurance of data, mandatory. So we do recognize that disclosure can be challenging, of course. Sometimes you have very complex supply chains, so that makes the scope 3 aspect of this very challenging. So the scope 1 and scope 2 is usually fairly easy for companies to do, but the fact that supply chains really span so many different countries, they're involved in so many different activities, tracking that can be very difficult for organizations, particularly small and medium-sized enterprises, especially if you're trying to get data from your supply chain and throughout your value chain. So we have a few tips on how you can do that later in the session today. The other challenge is certainly lack of standardization. I mentioned a few of the stock exchange regulations, things like IFRS, TCFD, even those standards all do vary in some way. So making that, so because of that variation, it can be very difficult for organizations, particularly ones starting out, to know what kind of information you should be disclosing, how many different regulations do you need to be aligning with. So that can certainly be very challenging for companies too. It also, to note, creates challenges for investors and stakeholders who are trying to glean information from that from that data and from that reporting. Because there's so many different ways of reporting, there's so many different ESG data points out there, it can be very difficult to even use this data. So again, going back to making sure that your data is accurate, complete, transparent, helps to align some of this standard, to clear the water a little bit of all these different types of regulation out there. And it can be resource intensive. That's certainly something that we recognize. It can take quite a bit of time to collect this information, not just the quantitative GHG emissions data, but all those other data points that I mentioned along the way about your strategy, your risk and opportunities, etc. It does take time to collect that information. However, because it takes time, it really is important to make sure it's done well so that you can reap the benefits and reap the rewards of the activity. So I've just named a few of the benefits that we've noticed for our clients when it comes to reporting on carbon and climate activities. So certainly it helps identify risks and opportunities in relation to climate change. This might not be something that you necessarily do unless you're needing to for disclosure reasons or other reasons. So identifying material risks that could really impact the business and impact your bottom line, impact your finances, impact your non-financial performance. And on the flip side, the opportunities that it can present to you as an organization to look into refining your products in a certain way that opens you up to new customer sectors. It could be producing new products, etc., etc. So identifying those risks and opportunities as part of this process can be a very beneficial activity for companies. Although there are different ways of reporting out there, which does make benchmarking and comparison quite challenging, there is a move towards making this more standardized, which will allow organizations to understand how they're performing, because you can collect all this data and you can say, right, now we understand our own organization, but what does that mean in the market? What does that mean for us? Are we good? Are we bad? And sometimes it can be very difficult to tell. So increasing regulation around disclosure, increasing coming together as standards will help that benchmarking, not only for the readers of your reports, but for yourselves too. Of course, it helps to keep up with emerging trends. So standards like the IFRS, TCFD, these are some of the ones that are leading, but certainly these types of data, these types of information is more in demand, as we've already noticed. So this reporting will help you to keep up with that emerging trend, even if you're not mandated to do so. It can help you to still be on the same level, the same par as companies that are reporting because they're mandated to do so. So for scope 3 specifically, improve transparency and traceability of the supply chain. This also has been a challenge for companies in the past, and it does again help you to identify what risks you might be exposed to in your supply chain, where you can make improvements within your supply chain that may make improvements to your business activities as well. You may also be able to better satisfy investor demand, attract new stakeholders. There are a lot of investors who are making capital available for companies who fulfill carbon requirements. For example, there may be people coming up through the workforce who want to work for more responsible organizations. So these understanding your carbon activities, understanding and making those carbon disclosures can help you to satisfy that demand from investors and other stakeholders. And then finally, consumers. So again, there might be consumers, customers, and they are certainly who are increasingly selective about who they work with based on criteria around carbon and climate. So this will also make sure that you're not closing yourself off to some of those customers and some of those clients that you will want to still remain open to and trading with. So I've talked about kind of the different scopes of carbon a little bit already, so I can explain what those are now if some of you are unaware. So one of the first, not so much the first place, one of the most challenging parts, as I mentioned already, for carbon disclosure is actually collecting that data for your GHG emissions. Scope 1 is emissions from operations that are owned or controlled by the reporting company. So this might be, these are emissions that you're actually generating yourself, usually by burning fossil fuel, using central heating, using cooling towers, etc. So that's your Scope 1, what you're actually generating, the emissions that you're actually generating yourself. Scope 2 is emissions from the generation of purchased or acquired electricity, steam, heating, cooling, etc. So this is when you buy services from a provider in order to have electricity, etc. So that's your Scope 2 emissions. So you're not directly contributing to those GHG emissions, but by buying those services, by purchasing that product, you are indirectly contributing to those GHG emissions. So those are called Scope 2. Scope 1 and Scope 2 are usually fairly easy to collect data for. A lot of people use procurement data for this. So how many kilojoules of electricity are they purchasing? How many liters of diesel are they burning, etc. So Scope 1 and Scope 2 people are usually becoming much more and more comfortable with nowadays with collecting that data. Scope 3 is the challenging part, especially for organizations that have big supply chains. So Scope 3 are any indirect emissions that occur in the value chain of your organization. So this could be both upstream and downstream. So this is divided up into 15 different groups. Purchase goods and services, so that the GHG emissions that are produced from you purchasing certain goods and services. Capital goods, so the GHG emissions within the capital goods that you own. Fuel and energy related activities, I won't go through each one, but all the different ones are listed here. Transportation, waste is also counted under Scope 3 emissions, business travel, employee commuting, leased assets, etc. Then we have the downstream, so transportation of your products, what happens to your products once they're sold, how they're used, how they're treated end of life. Downstream leased assets, franchises, investments, etc. So it's a huge scope. It can be very overwhelming for people, even those who've been doing this for many years. This can be overwhelming and a lot of information to be able to track and keep in mind. It doesn't have to be overwhelming. There are different ways that you can deal with this Scope 3 data collection in order to disclose. And we have kind of, there's a few, I would say you go through 3 steps in order to collect this data. The first is to determine, again, we're going back to the materiality strategic activities here. So determine the most relevant Scope 3 categories. So out of these 15 categories, which ones are most relevant for you as an organization? Can you estimate which of these have your biggest carbon contributions? Often it's purchase goods and services or capital goods, maybe even business travel or employee commuting. Those are often some of the bigger categories of Scope 3 emissions. So the first thing to do is identify which are the biggest ones. You don't necessarily have to collect every single piece of data for every one of these 15 categories. You can scope these in a way that becomes more manageable and actually more meaningful for you as an organization. Once you've identified the Scope 3 categories that you are going to collect data on and disclose, you then need to look at how you're going to go about collecting that data. So I've just got a small diagram under here which says actual data all the way through to averages. So how you collect Scope 3 data can be very varied. You can collect actual data. So this means going to every one of your suppliers asking them to fill in an Excel form or an SAP platform to collect the actual data from them. So your scope 3 emissions will be their scope 1 and 2 emissions. So they probably already have that data in some format, but for you having to collate all of that, bring it together, is a huge, huge task. So again, another option is averages. So instead of collecting data from all your suppliers, you go to your own data and you look at, okay, how much am I purchasing of, how much cotton am I purchasing? And then you can go and look at publicly available data sets out there, which can tell you, okay, if you purchase X number of kilos of cotton, that is X number of carbon emissions. So these are obviously two extremes. We often recommend you go somewhere in the middle. So for the more material scope 3 emissions, your bigger scope 3 emissions, collect that data from your suppliers as much as you can, but the rest you can rely on averages. And over time, the amount that you collect actual data may increase over time. It's certainly not going to be something you do overnight. And then finally, step 3 is actually collecting and calculating those emissions. Once you know your emissions, once you know kind of your base, where you are, it's important to look at setting targets. So often as part of disclosure, it's not just about collecting the data, but it's also about disclosing what your targets might be. So I'm not sure how many of you heard of science-based targets, but this is a internationally well-known guidance for setting targets for GHG emissions that are science-based. What that essentially means is that the targets that you set are aligned with reduction of global emissions by 1.5 or 2% by 2050. So you can use something like science-based targets to help you to guide your emissions target setting. You can submit those to SBTi if you want to, or you can just use the guidance as help as well. But there are kind of 3 areas we usually recommend that companies focus on when they're looking at how to set their targets. So first, focus on emission cuts. So certainly, where can you make improvements? Where can you be more efficient in terms of your electricity use, in terms of how you're using your suppliers, etc. Are there ways that you can actually immediately, quickly and significantly cut your use of carbon producing activities, products, services, etc. So this is obviously this is the best way to hit your targets, to reach targets, because it's making a real impact as well. It's also often something that's maybe within your control. The next thing will be to set long-term and near-term targets. So what can you cut right now? What can you cut later on in the coming years? So where can you kind of work towards? A lot of people are setting net zero targets. Those are difficult to achieve for sure, but I think looking at them as a phase can make them a little bit more palatable. And then, of course, the value chain, looking at where your value chain, how can you work with your suppliers? How can you work with other business partners to improve carbon emission contributions in general? Are there ways that you can collaborate to reduce both sets of carbon emissions? And that's another obviously really important way to make sure that you can contribute to reduction in global carbon. The other way that you can do this is things like offsetting your emissions, etc. But that really would be the last piece of carbon reduction. When you've tried everything else, okay, what can you potentially offset? Which means investing in climate finance, etc. I'm going to pause there and hand over to my colleague to take you through the next few slides.
Thank you, Katie, for this insightful session. By the way, I have to say it's a lot of information, but again, I feel there's always a starting point. So I got overwhelmed in the beginning when I first got introduced to GHG and carbon emissions, but I think it's a learning curve, whether it's for me or everyone on the call. So thanks, Katie, for this insights. Thanks, Hassan, for the introduction, and thank you, Pallavi, behind the scenes, who is the responsible person actually behind all of this. Good to be with you all here today. Just gonna cover a couple of points. Climate data reporting, why is it important? Really. Katie covered part of it to an extent. I think a lot of you know it already, but it's always good to have a reminder. First comes regulatory requirements. As Katie mentioned, there's a lot of regulations coming up, whether it's from the investors or from the stock exchange, whether it's in UAE, Malaysia, Singapore, US, Europe, it's all there. For example, NASDAQ, I believe they have 30 points criteria on GSG and reporting. And the first one is climate change. So a lot of focus is happening in this space. It's very important that we as business leaders take the initiative and embrace it from the beginning. And again, it's a journey, I think, which will never end. So regulatory requirements is one of the reasons, important reasons why we should consider it. It's a competitive positioning. So in today's world, as we all know, business is becoming very fierce. Competing for clients is becoming much more difficult. It's always good to have a competitive edge over our competitors, whether it's because of, as mentioned, regulatory requirements, whether it's even because of the clients, our clients. And by the way, and probably you noticed, clients are becoming more aware. There's a lot of awareness in that space on climate change. Even schools, they're teaching kids. I never had this opportunity when I was young, but even in schools nowadays, they're teaching them. So the next generations, they're becoming more and more climate oriented and climate focused, and they're worried about the environment. So it's becoming more and more important. And at the end of the day, we are, our livelihood as businesses is based on them. So they have the money, they can choose where to spend, right? So competitive positioning is very important, whether it's clients, whether it's even our investors, and whether it's because of regulation. Improve resource allocation, that's also important. How? You might ask, it would improve our resource allocation. Once we implement these requirements and do the data reporting, climate data reporting, you would be able to have a sense of what is, I'm getting a question here right now, by the way, sorry. So if you have any questions, please post them. We'll go through them, I think, at the end. So improve resource allocation, how does this happen? Once you implement or do the reporting and climate data reporting, you would be able to know what resources can be cut down, if there is any processes that needs to be changed, if there is any equipment that needs to be updated, you would be able to have this information. And that's what it means by improved resource allocation. Second, build trust with consumers and investors. As mentioned, it's becoming more and more important. 85%, as mentioned here, of investors believe ESG accountability leads to better returns, which I'm a strong believer in this after understanding this space very well. It also improved company governance over risk. Risk is one of the issues that has to be taken into consideration. We face a lot of risk these days, and having a proper governance from an ESG perspective is extremely important. I even see now positions, non-executive director positions, by the way, on companies that revolve around ESG. So improving company governance is also important. And finally, make meaningful, measurable climate improvements. At the end of the day, if we believe that we are working and doing something for a good cause, and we're at the same time helping the environment, whether it's for us or future generation, you will feel proud, you will enjoy it, and you will enjoy working for this company and enjoy giving back to the community. Next slide, Katie, please. So good practices, some of the good practices that we have seen some companies or some of our clients do or implement. One, that's important, understand your requirements and objectives. So this is extremely important. And when I say requirements and objectives, it could be your company leadership team vision for the future, where I want to be 5 years down the road, where I want to be 10, 15, 20 years down the road. Second is, as we mentioned before, is to understand what are our investors ask, right? Because at the end of the day, these are the people. So taking the investors, our clients, their regulations, where we want to be in the future as a company, all of this has to be taken into consideration and understood. Second is obtain buy-in from all stakeholders. And when we say stakeholders here, it's not necessarily only investors, and it's not necessarily only, I believe, in my opinion, regulatory bodies. It's everyone, even clients. So it's important to take this buy-in and engage with these clients and also our employees, by the way, internally. Because at the end of the day, believe it or not, even if if you are responsible to do this initiative, but you don't have the buy-in from the employees and your colleagues, it's not going to happen. So very important to engage with them and tell them why we're trying to do this, and most probably they'll be excited about it because they also believe in it. So having all the buy-in from all stakeholders is extremely important. Determine accountabilities and establish strategic goals. In anything you want to do to achieve something, you have to have accountability and establish KPIs, because if we don't have goals, nothing will be achieved. So it's extremely important to know whom to approach, how to approach them, and what are the objectives. Based on these objectives, we can do small milestones to achieve these objectives, whether it's 2, 3, 4, 5 years down the road. Perform a gap assessment. It's important also, I believe, and the reason why a gap assessment, what it does really at the end of the day, it's like gives you a roadmap. Am I going in the right direction? Am I implementing the things that needs to be implemented? Is there anything missing? It gives you an indication, am I going in the right direction or not? Especially if it's new to you, gap assessments are highly, highly recommended, because at the end of the day, you don't want to go a long way and then discover that there's something missing. So if you do a gap assessment early during your journey, it will give you an indication, yes, I'm in the right direction. This is what I need to do. Okay, I have few things, bits and pieces missing, and these are the things that needs to be done. So it's very important also. Establish repeatable processes and required controls. Why do we need to establish repeatable processes? If we want to measure anything, we need to benchmark against something. So against a baseline. So once you have a repeatable process, at least at the end of the duration, a year, 2 years, you can see the trend and you can see how well you improved. And you can even find, based on the analysis you can conduct, you can find trends where it helps you make very, very important decisions moving forward for your company. Verify externally. So why would you recommend? You can always verify internally, your own team, but it's always good to have a fresh set of eyes, because it's sometimes difficult to assess your own work. So it's always good to have a second set of eyes, fresh eyes who haven't seen your system before. That's one. Also, it's important really just to get the experience of the external verification company. For example, with us at LRQA, we assess and verify lots of companies. So when our verifier attends or visits your company, what will happen, you will get the best practice and the industry practice, whether it's in oil and gas, whether it's in manufacturing, whether it's in trading, whether it's government institute, you will be able to get the experience from the verifier based on what we have seen elsewhere. That's a wealth of knowledge. And finally, I think it's important as a good practice, honestly, from my own simple experience, is to invest in a good software when you're collecting data. I feel it's important, honestly speaking. Why? Because it gives you the ability to have clear information, neat in a nice, good manner that you can gather it. If you collect it on an Excel sheet, for example, it's not easy it might get messy. So if you can invest in a good software where you can collect this data, I would also highly recommend this. Moving to the next slide. All right, so how to embed good practice. As we mentioned, we start with a gap assessment, review software. We covered it in the previous slide. And the methodology, skill set is very important, and cultural alignment. Then this, based on the gap assessment results, it cascades into operation. So you implement the outputs from the gap assessment during operation, as we mentioned, collect aligned standardized data, cleanse and analyze, and transform into reportable format. Based on this report, after the operations phase is completed, it goes to the management. The management will then be able to review the results, identify any room for improvement, and allocate resources and actions moving forward. Finally, verify and repeat. So you get verified, whether externally, and then repeat the process. Now, having said that, when you say repeat, it's for continual improvement. And from Katie's slides, as you can see, maybe it might be overwhelming. So you can always start in a phase approach. So I've seen some clients who start, for example, I mean, I don't know if there's a poll question. Maybe Pallavi can help me with it. How many are considering to be verified externally within the next year, and for which verification scheme? Because there's many, right? There is ISO 14064. There is PAS 2060 for carbon neutrality, which I believe will be upgraded next year. It's gonna get obsolete next year, and it will be replaced by ISO 14068, I believe. So there's a lot of schemes that you can go for. So instead of going, for example, to a high level standard, like for example, the GRI, you can start with PAS 2060 or ISO 14068, and then go to ISO 14064. And in ISO 14064, you can go for limited assurance, and then you can go for reasonable assurance. So it's a journey, honestly speaking, but to start somewhere is very important today. Start somewhere, build on it, and capture the excitement, I guess. Moving to the next slide. Things to avoid, and finally, things to avoid: common mistakes in data reporting, unclear boundaries. Once you want to do or take the initiative to do the data reporting, it's very important to have clear boundaries, i.e., what's the scope? What emissions you want to focus on, direct, indirect emissions, what are the locations you want to cover if you're a multinational company. The boundaries of the scope has to be very clear. Inconsistent or incomplete reporting. Of course, if it's not complete reporting, then it's difficult to make any decisions which would be helpful for the organization. Poor stakeholder engagement, as we mentioned. It's important to engage with all stakeholders, whether it's your clients, investors, even your suppliers, by the way. Even you have to engage with your suppliers. So investors, clients, employees, and suppliers. Using a one-size-fits-all approach. I haven't seen it many times, to be honest, from my personal experience, but we wouldn't recommend at all to use one format or follow something that has been done by another company. Why? Because every company is unique. Your structure is unique. The business you're in is unique. So a company who is operating in oil and gas is different from a company who's operating in transportation. So it doesn't really work. A company who is in, for example, who's doing food storage, one of the main emissions would be refrigeration. If it's transportation company, it would be fuel or gas or diesel, right? So every company is different. And if you follow one approach or from another company, what will happen? Either you will have more than what you require, so it's going to be overwhelming, right? Or it's going to be less. So most important, take into consideration what's your company objectives, what are your stakeholders are asking from you or expecting from you, and accordingly follow, right? Limited validation, it goes without saying. In the management system fields, limited validation means increase in error margins, right? And if we increase error margin, then it will be difficult for us to assess where we stand today. So avoid limiting your validation. Validate, always validate. So when you capture your data, collect the data, have somebody to validate this data. Always, it's very important. Treating the processes as a compliance exercise. Like with anything, once we take this initiative and only do it to demonstrate certain thing or for compliance, you're not getting the value out of it. And when I say value, is cutting cost and satisfying your stakeholder requirements, whether again, clients, clients, investors, even employees, you're missing out. So we might as well, right? Do it properly, not as only compliance, because we're spending the effort and time anyways, right? So we might as well do it the right way, right? Variance in approach, again, variance in approach would make it difficult for you to see insightful trends. So if once you agree on an approach or want to go forward with it, don't change it many times over the years. This will help you identify trends in your company and make decisions accordingly. And finally, limited expertise in-house. We have to engage. Again, our employees are important. So having the employees with the right capability, with the right training, with the right understanding is very important. If it's not available, get consultants who can help you. Only recommendation, if you get consultants, just make sure that there's knowledge transfer. I've seen some cases where a company gets a consultant, for example, and they depend on him fully without ensuring knowledge transfer. So either you have in-house or hire consultants, knowledgeable consultants, like Katie and her team in this case, but just make sure that you make sure that the knowledge is transferred. And that's it for me, I guess. Katie?
Thanks,
Don't forget,
Ayman.
ask the questions. We see a lot of questions coming in. We'll wait till the end. We'll answer as much as we can. If we can't answer them, send us an email and we'll be more than happy to answer them. Or you can visit our website, by the way. Sorry, Katie, over to you.
No, thank you very much. I'll just very quickly jump to these couple of slides in terms of kind of how you can get support or how you can go about doing this reporting. I also noticed a question, have you worked on IFRS reports? Are there specimens available? So I can answer that question on this slide as well. I'm not sure if these are IFRS aligned yet, but these are some of the leading reporters in the region. To find these, there's a few different benchmarking, online benchmarking organizations such as DJSI, the Sustainability Guidebook. I pulled these, I can't remember where I pulled these from, but a CDP, I think it was. So this is CDP A scorers in the A category. So there's definitely lots of reports out there publicly available. These are some of the best ones we've seen across the region, but there's plenty out there. As IFRS becomes more widely adopted, I'm sure these organizations and other leaders will be adopting them very soon. So yes, these will be some good specimens for you to look to to help you with your reporting. And then there's a few different ways that you can get help. As I mentioned, you can certainly seek help from external consultants such as ourselves to walk you through the various steps of disclosure, starting from identifying gaps, bridging those gaps, submitting a report for publication, and then looking at recommendations, etc., for improvements, and bringing that circle back around. And then, of course, assurance as well. We do provide assurance services to clients where we are very careful to make sure that we provide very useful and valuable assurance services for those clients. So it's not just a tick box exercise. Okay, I answered one question. Maybe we could take a look at the other questions here. I have a question, a clarification question. Boundaries refers to scope. So I think this is referring back to one of my slides on scope 3 methodology. So what we mean by boundary is not the scope. So scope 3 is all of these 15 categories. If you need to identify which of those categories are relevant to you. Then in terms of boundary, it's where does your materiality boundary end? Is it your top 20, the suppliers that you spend, top 20 spend with suppliers, or suppliers that you spend, I don't know, 20% or more of your overall spend with, etc. So that's setting the boundary of knowing, okay, where do we stop when it comes to collecting that data, because we can't collect every single piece of data. Questions are coming in thick and fast. If there's any that you want to answer, please do jump in. Which standards to follow for sustainability assurance? I'm noticing that question here. Ayman, you might want to comment on this one, but there are certainly quite a few out there. I'll let you answer that one, Ayman.
Yes, there is a few out there when it comes to sustainability assurance, and I mean, when it comes to carbon, it's the most common one I've seen is 14064 for carbon emissions. So this is the main one. There's, as mentioned, there's also the GHG protocols. There is also the GRI. There's a lot of them. It really depends on your industry and what scheme fits you most. We can have this, by the way, a discussion. So if you send us an email, I can have a chance to sit and discuss with you what would be the most suitable in this case. But there's a lot of them.
Yeah. I have a question on regulations specific to UAE for sustainability reporting or carbon emissions reporting. Currently, no, I don't believe there's any mandatory ones, but certainly there are guidance principles coming out from the region that are encouraging sustainability reporting and carbon emission reporting. So I think it's not going to be long until the UAE does start to mandate reporting. I had another question on, okay, I'll try this one. When it comes to scope 3 emissions related to third-party transportation, we are operations involved in rural areas and activities which are very critical to collect data. Absolutely. So the question is in this case, what's the best approach for collecting that data? I think it's going back to what I said on this slide. So making sure that you know your biggest scope 3 contributions. So which are, again, setting that boundary, which are your biggest suppliers, which are the heaviest carbon products and services that you acquire, and focusing on those first of all. You can't collect everything. And then once you've established that boundary, once you've established what you're going to be collecting, then you can look at, okay, which ones of those can you collect actual data going to those suppliers directly to collect the data, and which ones you can use averages for based on the volume that you buy. Linked to that, there's a question on, do we provide ESG software for clients to do their reporting? No, we don't provide software to report, but we do provide software or tools to collect carbon data. So we do have a platform, it's called LRQA EIQ platform. And this platform has been around for many, many years, and it focuses on supply chain data, and particularly supply chain. One of the facilities of it is supply chain data, and it does include carbon data collection, forms, templates, etc. We also assure that data through our third-party assurance site visits as well, audits, etc. So yes, there is software available from LRQA. There is, of course, other software available globally as well for collecting data and actually producing those reports. Maybe I'll pick one or two more since we have a minute left on the webinar. Can you change scope 3 methodology year on year for actual data reporting? Yes, you can. However, I wouldn't recommend you change too extensively. I would recommend you start with that boundary setting, start with that scope, and then each year you can certainly widen it. You can start with maybe averages data collection, and then you can widen it to collecting actual data. But if you change it too much every year, it becomes very difficult for you to keep track of your actual emissions and therefore your own performance on data. So yes, in theory you can. We wouldn't recommend that you make too many changes each year. I think that's time. Ayman, did you have any other questions you wanted to answer before we close?
What are the most used? I mean, there's a trying to find the questions, but I think we'll take these questions later on and answer them. I mean, if you send us the questions, we'll be more than happy to answer them. I think I got a message from the team. I have to wrap up. We have to wrap up. Guys, it's been a pleasure to attend with you this session. If you have any questions, again, thanks Katie for the insights. Thanks everybody for attending. If you have any questions that haven't been answered, please send us. You have our emails. It's mentioned in the chat box. You can also visit our website, and we will get these inquiries and we will address them accordingly. Don't forget at the end to complete the survey. This survey will help us improve or give us an idea in future what sessions, what topics you want to us to talk about. Thanks a lot. Thank you, Katie. Thank you, Hassan. Take care, everybody, and have a good day.
Thanks, everyone.